Have you noticed? The S&P 500 has hit 17 record highs. Wall Street is in raptures, yet your account hasn't seen much profit. Why aren't ordinary people reaping the market's rewards? In truth, lurking beneath this lies a hidden risk capable of reshaping the global financial landscape. These risks are accelerating and accumulating, proving far more perilous than you might imagine. Today we delve deep into the truth behind this market boom. Understanding it is key to safeguarding your wallet. Yet beneath this superficial prosperity, latent risks are steadily accumulating, possessing both formidable concealment and destructive potential. The current global economic recovery remains uneven. U.S. growth relies heavily on a single sector, while other major economies like the Eurozone and Japan grapple with sluggish expansion. Emerging markets face challenges from a strengthening U.S. dollar and capital outflow pressures, testing their economic stability. According to the IMF's October 2025 World Economic Outlook report, global economic growth is projected at 3.1% for 2025. Within this, the Eurozone is forecast at just 0.8% and Japan at 0.6%, both below the global average, whilst emerging market and developing economies are projected to grow at 4.2%. This represents a deceleration from 2024's 4.5% rate. Moreover, over 60% of emerging market nations face net capital outflow pressures, with some countries' local currencies depreciating by more than 10% within the year. This global economic imbalance means the prosperity of the U.S. stock market lacks broad economic foundations, appearing more like a localized, temporary speculative rally. For ordinary investors, the most dangerous state in such a market environment is being blinded by short-term profit effects and overlooking the existence of risks. Most investors tend to blindly follow the market during uptrends, mistaking short-term market fluctuations for long-term trends, while neglecting their own risk tolerance and genuine understanding of investment targets. Data from the Investment Company Institute reveals that throughout 2025, net inflows into U.S. equity mutual funds reached $587 billion, with over 60% of these funds entering within 3 months of the S&P 500 index surpassing its historical peak. This statistic starkly illustrates the herd mentality of retail investors chasing rising markets. In truth, the potential financial storm looming within the coming year could be triggered by multiple factors. These include a valuation correction stemming from AI industry growth falling short of expectations, a liquidity crisis sparked by a concentrated outbreak of default risks in private credit markets, or uncertainty shocks arising from escalating global geopolitical conflicts. These risk factors are intertwined. Once triggered, they could set off a chain reaction, inflicting severe damage on global financial markets. What warrants greater vigilance is that risk transmission speeds far exceed historical norms. Against the backdrop of financial globalization and digitalization, volatility in one market can propagate instantaneously to others. The heightened interconnectedness of various financial assets further amplifies the destructive potential of such risks. The Bank for International Settlements Financial Stability Report for the third quarter of 2025 indicates that the current global financial market interconnectedness index has reached its highest level since the 2008 financial crisis. Volatility originating in a single market can now propagate to major global financial centers within 48 hours, representing a 35% increase in transmission efficiency compared to 2019. We must therefore maintain a sober awareness that the current market prosperity is not impregnable, but rather a precarious balancing act on an extremely perilous tightrope. Every investor must exercise heightened vigilance, rationally assess the risks within their investment portfolios, and avoid becoming the final footnote in the market's revelry. The severe divergence of the K-shaped economy has become one of the most pronounced features of the current global economy, particularly evident in the U.S. market and supported by ample economic data and market phenomena. Structurally, the core characteristic of the K-shaped economy is the extreme imbalance in growth drivers. A small segment achieves rapid expansion while the vast majority of the real economy stagnates or even contracts. According to final revised figures from the U.S. Department of Commerce, the nation's GDP growth rate for 2025 stood at 2.3%, a modest increase from 2024's 2.1%. However, a detailed breakdown reveals that AI-related investments contributed a full 1.02 percentage points to GDP growth, accounting for a staggering 44.3% of the total increase. This makes AI the absolute cornerstone of U.S. economic expansion. This growth imbalance is even more pronounced in capital expenditure data. Data from the Bureau of Economic Analysis shows that in 2025, US AI-related capital expenditure reached $468 billion in real terms, a year-on-year increase of 48.7%, accounting for 1.52% of GDP. The Big 7 US tech giants contributed 79.8% of the nation's AI investment, with their combined capital expenditure totaling $374 billion in 2025, a 52.3% increase over 2024. This single-engine growth model exhibits extreme instability, akin to a class's average academic performance being entirely dependent on a handful of gifted students. Should these gifted students experience fluctuations in performance, the entire class's results would plummet significantly. Specifically, AI-related capital expenditure is concentrated in data center construction, chip R&D, and AI algorithm optimization. Tech giants including Google, Meta, Microsoft, Amazon, and Apple are the primary drivers of this investment wave. Leveraging their technological advantages and financial strength, these firms have engaged in an intense arms race within the AI sector, while substantial investments have accelerated the rapid development of related industries. They have also further concentrated economic growth. Data from the U.S. Census Bureau's business survey reveals that in 2025, the top 10 U.S. technology firms accounted for 62.7% of the sector's total revenue, a 14.4 percentage point increase from 48.3% in 2020, marking an unprecedented level of industry concentration. This fervor in the AI sector stands in stark contrast to the widespread difficulties facing the U.S. real economy. Data from the Institute for Supply Management indicates that the U.S. Manufacturing Purchasing Managers Index PMI fell below the boom-bust line in 8 months of 2025. The December PMI dropped to 47.9, down from November's 48.2, marking the 6th consecutive month in contraction territory and signaling persistent weakness in manufacturing activity. Detailed breakdowns reveal that the new orders index stood at 45.3, the production index at 47.1, and the employment index at 46.8, all below the 50-point threshold, reflecting widespread weakness across the manufacturing supply chain. In the retail sector, U.S. Commerce Department figures revealed that while retail sales grew by 2.8% year-on-year in 2025, the consumer price index rose by 4.1% over the same period. Adjusted for inflation, real retail sales declined by 1.2% year-on-year. This marks the first annual contraction in real retail sales since 2020, signaling a marked deterioration in household purchasing power. The operational challenges faced by small and medium-sized enterprises (SMEs) were particularly pronounced. Data from the U.S. Small Business Administration revealed that bankruptcy filings by SMEs reached 128,000 in 2025, a 35.7% year-on-year increase, with service sector SMEs accounting for 68.2% of these bankruptcies. Numerous small and medium-sized service enterprises encountered operational difficulties due to rising operating costs and insufficient market demand, resulting in a significant increase in bankruptcy rates compared to previous years. On the cost side, average labor costs for U.S. SMEs rose by 5.3% year-on-year in 2025. Energy costs increased by 8.7%, and rental costs climbed by 6.2%. On the demand side, declining household purchasing power led to an average customer attrition rate of 18.3% among SMEs, far exceeding the 11.2% recorded in 2024. This economic divergence directly translated into the stock market, forming a K-shaped divergence pattern. Among the constituents of the S&P 500 index, the Big 7 represented by Apple, Microsoft, Nvidia, and Amazon, leveraging their AI sector investments and robust performance, saw sustained share price increases, becoming the core drivers propelling the index to new highs. Data from S&P Dow Jones Indices reveals that since the start of 2025, the S&P 500 has risen by 17.2% cumulatively. These 7 firms contributed 81.4% of this gain, accounting for over 14 percentage points of the increase. The remaining 493 constituent companies averaged a mere 2.8% rise, with 217 of them experiencing share price declines. Across the broader market, numerous traditional sector companies, particularly small and medium-sized enterprises, have seen lackluster share price performance, with some experiencing significant declines. The Russell 2000 index has cumulatively fallen by 3.7% in 2025, with stocks in sectors such as consumer manufacturing and traditional services averaging a 7.2% decline. Many consumer manufacturing firms saw declining performance and falling share prices due to rising raw material costs, increased labor expenses, and weak market demand. Small and medium-sized service enterprises face survival pressures from reduced customer bases and higher operating costs, with their stocks attracting little market capital attention. Federal Reserve data on capital flows revealed that throughout 2025, $1.2 trillion flowed into technology stocks, while only $186 billion combined flowed into traditional manufacturing and service sector equities, demonstrating a pronounced capital siphoning effect. This stock market divergence has created a peculiar market phenomenon. While news outlets daily report bullish headlines of record-high indices, ordinary investors' portfolio returns remain underwhelming, with many even incurring losses. Data from the U.S. Financial Regulatory Authority indicates that in 2025, the average investment return for ordinary U.S. investors stood at a mere 2.3%, significantly below the S&P 500 index's 17.2%, with 58.7% of retail investors recording losses. The root cause lies in the fact that most retail investors' holdings are concentrated in traditional industries and small to medium enterprise stocks. These assets happen to be positioned at the plummeting end of the K-shaped economy, unable to benefit from the dividends generated by the growth of the AI industry. More critically, the divergence within the K-shaped economy continues to intensify. The affluent, holding substantial tech stocks, see their wealth grow rapidly, while ordinary citizens face mounting pressures from a sluggish real economy, increased employment pressures, and sluggish income growth, leading to a widening wealth gap. Taxation data from the U.S. Internal Revenue Service reveals that by 2025, the wealth held by the nation's wealthiest 10% accounted for 73.2% of total societal wealth, a 2.1 percentage point increase from 2024 and a historic high. The wealth share of the top 1% reached 34.8%, up 1.5 percentage points from the previous year. Concurrently, the median household income in the United States increased by 2.1% year-on-year in 2025. Yet after adjusting for inflation, it experienced a real decline of 1.9%. This marks the third consecutive year of real income contraction. The polarization within the labor market further exacerbated wealth disparities. Data from the U.S. Bureau of Labor Statistics revealed that the average hourly wage in the technology sector reached $58.7 in 2025, a 6.2% annual increase. In contrast, the average hourly wage in traditional manufacturing stood at $32.30, rising by 3.1%, while the service sector averaged just $24.50, a 2.8% annual increase. The unemployment rate in the technology sector remained consistently low at 2.1%, whereas traditional manufacturing and services recorded rates of 5.3% and 6.7% respectively. This divergence in employment and income has led to persistently rising living pressures for ordinary citizens, further contracting their purchasing power. This, in turn, exacerbates the weakness in the real economy, creating a vicious cycle. For investors, recognizing the divergent landscape of the K-shaped economy is a prerequisite for making sound investment decisions. Only by identifying which pole of the K-shaped economy their investments reside in can one accurately assess future prospects and avoid being misled by the false prosperity of indices. As the current frontier of global technological advancement, the AI sector harbors revolutionary opportunities while simultaneously generating substantial market bubbles, presenting a stark coexistence of opportunity and risk. Firstly, the immense potential of AI technology is undeniable. Widely regarded as the core driver of the fourth industrial revolution, it is profoundly transforming human production and lifestyles. Technologically, breakthroughs in natural language processing, computer vision, and machine learning continue to expand its application scenarios. In industrial production, AI-powered robots enhance manufacturing efficiency and product quality. Within healthcare, AI-assisted diagnostic systems aid physicians in more accurate condition assessment and improve treatment outcomes. In finance, AI algorithms enable more precise risk management and investment decisions. While in daily life, AI products like intelligent voice assistants and autonomous vehicles are becoming increasingly prevalent, simplifying people's routines. This expansion of application scenarios demonstrates the vast development prospects of AI technology, attracting global capital investment. Data from the Semiconductor Industry Association indicates that the global AI chip market will reach $128 billion by 2025, representing a year-on-year growth of 56.3%. Within this market, Nvidia holds an 82.7% share, maintaining its absolute dominance. As the industry leader in AI chips, Nvidia's performance has been nothing short of spectacular. Its Q3 2025 financial report revealed a 61.2% year-on-year revenue increase to $221 billion, with data center business revenue reaching $187 billion, an 83.5% rise, setting a new historical record. This performance fully reflects the robust market demand for AI chips. Beyond the chip sector, the AI software and services market is also experiencing rapid growth. Gartner statistics indicate that the global AI software and services market reached $286 billion in 2025, representing a 42.8% year-on-year increase. However, in stark contrast to the immense potential of AI technology, current market hype surrounding AI concepts has descended into frenzy, creating a severe bubble. The core characteristic of this bubble is the severe disconnect between corporate share prices and fundamentals, with market capital blindly chasing any company with an AI connection while disregarding actual profitability and business models. Research from Bank of America indicates that global AI-related venture capital investments will exceed $1.2 trillion by 2025. Of this, 47.3% flows into startups established within the last 3 years, lacking clear profit models and relying solely on AI concept speculation. These enterprises often secure substantial funding in their early stages, with valuations soaring rapidly. Yet their core technologies remain immature. Products fail to achieve commercialization, and they are fundamentally incapable of generating sustainable profits. Data from the National Venture Capital Association indicates that by 2025, the average valuation of U.S. startups will reach $1.58 billion United States dollars, representing a 67.4% increase from 2024. Yet these firms' average revenue stands at merely $23 million United States dollars, with average losses reaching $120 million United States dollars. This results in a valuation-to-revenue ratio of 68.7 times, far exceeding the tech industry average of 12.3 times. This phenomenon is even more pronounced in the stock market, where many traditional enterprises see their share prices surge with consecutive daily limits merely upon announcing forays into AI. Investors remain entirely unconcerned with the scale of investment, technological capabilities, or developmental prospects within the AI domain. S&P Dow Jones Indices statistics reveal that in 2025, 137 traditional industry-listed companies announced AI transformation or AI business expansion. These firms saw an average 18.3% share price increase within 5 trading days of their announcements. However, only 23 of these companies actually invested more than 5% of their revenue in AI, with the remainder investing less than 2% and demonstrating no substantive technological breakthroughs or operational implementations. The current development of the AI industry faces 2 critical bottlenecks, which are also the core reasons why the bubble is unsustainable. The first bottleneck is the constraint of power supply. AI technology development is highly dependent on data centers, whose operation consumes vast amounts of electricity. A Goldman Sachs research report forecasts that global data center electricity demand will accelerate by 175% in the coming years. In the United States, data center power consumption growth will surge from less than 0.5% annually over the past decade to 2.5% to 3%. By 2030, U.S. data centers are projected to account for 12% of the nation's total electricity consumption. This substantial electricity demand poses severe challenges to global energy supply. Data from the U.S. Energy Information Administration indicates that U.S. data centers consumed 327 billion kilowatt-hours of electricity in 2025, representing a 2.8% year-on-year increase and accounting for 8.3% of the nation's total electricity consumption. Projections suggest this figure will rise to 415 billion kilowatt-hours by 2027, increasing its share to 10.1%. Whether relying on traditional fossil fuel power generation or renewable energy sources, expanding capacity demands considerable time and substantial investment. Grid upgrades cannot be completed swiftly either. A report by the Electric Power Research Institute indicates that the average age of the U.S. power grid has reached 42 years, with over 70% of transmission lines and transformers requiring modernization. Completing these upgrades will necessitate at least 8 years and an investment of $2.3 trillion United States dollars. Regarding renewable energy generation, By 2025, solar and wind power will account for 21.7% of U.S. electricity generation. However, the intermittent nature of renewable energy necessitates complementary energy storage facilities. Currently, U.S. storage capacity meets only 12.3% of peak renewable generation loads, falling far short of requirements for large-scale grid integration. Should power supply fail to keep pace with AI industry expansion, AI data center operations will face severe constraints, halting both technological R&D and practical applications. The second bottleneck concerns the challenge of demand and monetization. Current AI investments by tech giants primarily serve as technological reserves and market positioning, lacking clear commercialization pathways. While numerous intriguing AI applications have emerged such as chatbots and AI-generated art, most remain in free trial phases, with few achieving significant commercial scale. Both enterprises and individuals exhibit low willingness to pay for AI products, particularly amid slowing economic growth and mounting operational pressures. Businesses increasingly prioritize cost control over substantial investments in AI solutions. Survey data from the McKinsey Global Institute indicates that by 2025, only 23.5% of global enterprises will be willing to pay annual fees exceeding $100,000 for AI products, representing an 8.7 percentage point decline from 2024. Meanwhile, the penetration rate of paid AI applications among individual users stands at merely 7.2%, with the majority opting for free versions. NVIDIA's performance growth relies heavily on tech giants stockpiling AI chips rather than actual demand from end markets. In 2025, 68.3% of NVIDIA's AI chip sales were procured by tech giants like Google, Microsoft, and Amazon for data center construction and R&D, while end-user enterprises accounted for just 21.7% of purchases and the consumer market less than 10%. Should tech giants discover that the return on investment for AI fails to meet expectations and begin cutting capital expenditure, demand for upstream products like AI chips and data center equipment would plummet. This would cause the entire valuation logic of the AI industry chain to collapse entirely. Indeed, some tech firms have already begun adjusting their AI investment strategies. In Q4 2025, Meta announced a 15% reduction in its 2026 AI capital expenditure, from $120 billion to $102 billion. Amazon also signaled it would slow the construction pace of certain data centers, lowering its projected 2026 AI-related capital expenditure growth from 45% to 32%. These signals indicate that tech giants' enthusiasm for AI investment is gradually cooling, and the bursting of the AI bubble may be only a matter of time. Therefore, investors must maintain a clear-headed understanding of the opportunities and risks within the AI sector. Rather than blindly following speculative trends around AI concepts, they should rationally assess companies' core technological capabilities, business models, and profit prospects to avoid becoming casualties when the bubble bursts. The private credit market, a vital component of the global financial system, has expanded rapidly in recent years. However, due to a lack of effective regulation and transparency, it has become a concealed and dangerous source of risk, with potential dangers no less significant than the subprime mortgage market that triggered the 2008 global financial crisis. According to the latest data released by the International Alternative Investment Management Association, by the end of 2024, the global private credit market had reached an asset management scale of $3.5 trillion United States dollars. This scale surpasses the annual GDP of France and Canada combined, establishing it as a force to be reckoned with within global financial markets. In 2025, this market continued its expansion, reaching $3.8 trillion United States dollars by the end of the third quarter, representing a year-on-year growth of 12.7%. Private credit, in simple terms, refers to loans provided directly to enterprises by non-bank financial institutions such as hedge funds, private equity funds, and asset management companies. Unlike traditional bank lending, private credit operations bypass the constraints of banking regulatory frameworks. Loan terms are determined through private negotiations between counterparties, and the entire market lacks unified regulatory standards and disclosure requirements, rendering it a substantial black box. Global asset management giants such as Blackstone, Apollo, and Carlyle are key players in the private credit market, leveraging their formidable capital-raising capabilities and flexible transaction models. These institutions dominate the sector. AMA data indicates that by the end of Q3 2025, The combined private credit assets managed by Blackstone, Apollo, and Carlyle reached $876 billion, accounting for 23.1% of the global market total. The rapid expansion of the private credit market stems primarily from the impetus of a global low-interest rate environment. Over the past decade, major economies worldwide have implemented accommodative monetary policies, resulting in persistently low interest rates and abundant market liquidity. Investors seeking higher returns have consequently channeled capital into alternative assets such as private credit. For enterprises, particularly small and medium-sized businesses with lower credit ratings unable to access public market financing, private credit has emerged as a vital funding channel. Federal Reserve data indicates that between 2015 and 2022, the U.S. federal funds rate remained persistently low at 0% to 2.5%. During this period, the global private credit market expanded from $0.8 trillion United States dollars to $2.9 trillion United States dollars, achieving a compound annual growth rate of 22.3%. However, as global monetary policy shifted, major central banks including the Federal Reserve began raising interest rates, leading to persistently higher rates and the gradual exposure of risks within the private credit market. Between March 2022 and July 2023, the Federal Reserve implemented 11 consecutive rate hikes, elevating the federal funds rate from 0.25% to 5.5%, with this level projected to persist until 2025. This rapid rise in interest rates substantially increased financing costs for private credit, significantly heightening repayment pressures for businesses. Private credit rates typically far exceed those of bank loans. According to Bloomberg statistics, the average interest rate for U.S. private credit reached 11.7% in 2025, a 4.9 percentage point increase from 6.8% in 2022. During the same period, the average corporate loan rate from U.S. commercial banks stood at 7.2%, widening the gap between the two to 4.5 percentage points. The core similarity between the private credit market and the 2008 subprime mortgage crisis lies in its lack of transparency, which constitutes its greatest risk. In private credit transactions, information such as loan terms, borrower creditworthiness, and the quality of collateral assets remains undisclosed. There exists no unified database or regulatory reporting system for public access. Even professional investors struggle to fully comprehend the true risk profile of private credit assets. Steve Eisman, the prominent investor featured in The Big Short, explicitly warned that the private credit market's opacity surpasses that of the subprime mortgage sector during the crisis. Whilst investors struggled to access underlying mortgage data during the subprime crisis, they could still obtain relevant information including loan default rates from credit rating agencies like Moody's and S&P through paid subscriptions. In contrast, the private credit market keeps such information entirely confidential, rendering it inaccessible to investors. Should market disruptions occur, investors would be utterly unprepared, forced to passively absorb losses. Research from the Institute of International Finance indicates that by 2025, only 12% of global private credit products will have undergone public disclosure. This stands starkly against the 47% disclosure rate for subprime mortgage-related financial products prior to the subprime crisis. In recent years, a series of alarming signals have emerged in the market, indicating rising risks within the private credit sector. In 2025, the sudden collapse of two seemingly unrelated enterprises sparked widespread market concern over private credit risks. Both companies faced allegations of severe financial fraud, centered on a core tactic, repeatedly pledging identical assets such as vehicles and equipment to secure loans from multiple private credit institutions. This practice of multiple pledges against a single asset flagrantly violated fundamental financial market principles, exposing critical flaws in the private credit sector's risk control framework. Although neither company was purely reliant on private credit, their collapse served as a stark warning of systemic fragility. Beyond fraud cases, private credit default rates began rising. A UBS research report indicated that the global private credit default rate reached 2.7% in 2025, up 0.9 percentage points from 1.8% in 2024. Projections indicate that by 2026, the global private credit default rate will climb to 5.7%, a 3 percentage point increase from 2025. Against a market backdrop of $3.8 trillion, this translates to potential losses exceeding $216 billion. Losses of this magnitude possess the capacity to inflict severe disruption upon the global financial system. More critically, risks within the private credit market exhibit highly contagious properties. Numerous financial institutions including banks, insurers, and pension funds have invested in private credit assets through various channels. Should a wave of defaults occur in this market, these institutions would face substantial losses, jeopardizing their liquidity and solvency and triggering a chain reaction. Data from the National Association of Insurance Commissioners indicates that by 2025, U.S. insurers' private credit investments will reach $687 billion, accounting for 8.3% of their total assets, while U.S. public pension funds' private credit investments reached $452 billion, accounting for 11.2% of their total investment assets. Should large-scale defaults occur in the private credit market, the net asset values of these institutions would significantly diminish, potentially leading to reduced insurance payout capacity and difficulties in pension fund disbursements. Simultaneously, risks within the private credit market could propagate to the real economy. Businesses unable to secure financing would face intensified operational difficulties, potentially slowing economic growth and increasing unemployment. Data from the U.S. Small Business Administration indicates that by 2025, 42.3% of small and medium-sized enterprises (SMEs) will rely on private credit for financing. These enterprises collectively employ 12.7 million people, representing 18.5% of all SME employees in the United States. Should the private credit market contract, these enterprises would struggle to secure sufficient capital to sustain operations, potentially triggering widespread layoffs and bankruptcies that further exacerbate the weakness in the real economy. Consequently, this $3.80 trillion black box of the private credit market has become a significant latent risk within the global financial system. Should these risks materialize, they would intertwine with issues such as K-shaped economic divergence and the AI bubble, potentially catalyzing a perfect storm of financial turmoil. Both the Shiller P, E ratio, and the Buffett Indicator core valuation metrics regarded as market mirrors of truth currently signal that U.S. market valuations have reached an extremely overvalued state, issuing strong risk warnings. These indicators, grounded in historical data and macroeconomic fundamentals, objectively reflect long-term market valuation levels, with their cautionary significance widely acknowledged by global investors. First, consider the Shiller P/E ratio, devised by Nobel laureate Robert Shiller and also known as the cyclically adjusted price-to-earnings ratio. Unlike the traditional price-to-earnings ratio, the Shiller P/E employs a company's average earnings over the preceding decade, adjusted for inflation, to calculate the ratio of share price to earnings. This methodology effectively smooths out the impact of economic cyclical fluctuations on corporate earnings, thereby more accurately reflecting the market's long-term intrinsic valuation. Historical data indicates that the long-term mean of the Shiller P/E ratio is approximately 16. A reading exceeding 25 is generally considered indicative of overvaluation, while a figure above 30 signals extreme overvaluation, signaling substantial downside risk in the market. Presently, the Shiller P/E ratio for the S&P 500 stands at 40.2, a level surpassed only during the peak of the dot-com bubble in 2000. Throughout the index's over 140-year history, research by Yale University's Professor Robert Shiller indicates that prior to the 2000 dot-com bubble burst, the S&P 500's Shiller P/E ratio peaked at 44.2. This was followed by a prolonged bear market spanning several years, during which the index plummeted by 50.2% between 2000 and 2002. Numerous technology stocks suffered catastrophic declines, inflicting substantial losses upon investors. The current Shiller P/E ratio is approaching this historical peak, indicating that market valuations have reached a highly speculative level. More alarmingly, the present Shiller P/E ratio not only far exceeds the long-term average but also surpasses the level observed on the eve of the 1929 U.S. stock market crash that precipitated the Great Depression. Prior to the 1929 crash, the S&P 500's Shiller P/E ratio stood at approximately 33.3, whereas the current figure of 40.2 significantly surpasses this historical benchmark. The lessons of history warrant profound vigilance. Historical patterns indicate that when the Shiller P/E ratio reaches extreme highs like 40, the market's annualized returns over the subsequent decade or even 15 years often turn negative or remain at extremely low levels. Researchers at Yale University, analyzing 140 years of market data, found that when the Shiller P/E ratio exceeds 35, The average annualized return on equities over the subsequent decade falls below 1%. This significantly underperforms the returns from low-risk assets such as bonds and cash over the same period. Consequently, investors purchasing S&P 500 index funds at current elevated valuations for long-term holding may well face prolonged losses or meager returns. Next, consider the Buffett Indicator, proposed by the legendary investor himself. It is calculated by dividing the total market capitalization of all listed companies in a nation by its gross domestic product. Buffett has explicitly stated this is the single best indicator for gauging market valuation levels. The core logic of the Buffett Indicator is that the total market capitalization of listed companies ultimately depends on the development of the real economy, with a reasonable proportional relationship existing between the two. Should the aggregate market capitalization of listed companies grow excessively rapidly, far outpacing GDP growth, it signals overvaluation and the presence of a bubble. Conversely, a slower growth rate indicates undervaluation and potential investment value. Historical data suggests the Buffett Indicator's reasonable range lies between 75% and 90%. Values exceeding 120% are considered overvalued, while readings surpassing 150% indicate extreme overvaluation. By the end of December 2025, the Buffett Indicator for the United States had reached a staggering 223.4%, far exceeding the reasonable range and even surpassing levels seen before the dot-com bubble of 2000 and the 2008 financial crisis. Data from the Federal Reserve's economic database indicates that prior to the 2000 dot-com bubble, the U.S. Buffett Indicator stood at approximately 153.2%, while it was around 135.7% before the 2008 financial crisis. The current figure of 223.4% substantially surpasses both these historical peaks, signaling that the total market capitalization of U.S. equities has become severely detached from the support of the real economy. Globally, the U.S. Buffett Indicator also leads the world, far exceeding other major economies. IMF data shows that as of December 2025, the Buffett Indicator stood at 112.3% for the Eurozone, 108.7% for Japan, 87.5% for China, and 132.6% for India, all below America's 223.4%. This further underscores the exceptional scale of valuation bubbles in the U.S. market relative to the global context. The surge in the Buffett Indicator primarily stems from the sustained rise in U.S. stock markets coupled with relatively sluggish GDP growth. Since 2020, U.S. equities have experienced a substantial rally, driving rapid expansion in the aggregate market capitalization of listed companies. By the end of 2025, this figure reached $69.8 trillion, representing an 82.7% increase from $38.2 trillion at the close of 2020. Meanwhile, U.S. GDP grew from $20.9 trillion in 2020 to $26.8 trillion in 2025, representing a mere 28.2% increase. The widening disparity between these two metrics ultimately propelled the Buffett Indicator to its historical peak. The warning signals from this indicator align closely with the Shiller P E ratio, both indicating that the U.S. market has entered an extremely dangerous valuation range. For investors, the extreme highs of these two indicators represent critical risk signals that demand serious attention. Market sentiment has become overheated, with investor optimism reaching its zenith. Historical patterns suggest that when market sentiment peaks, it often marks the critical turning point for market reversals. Survey data from the American Association of Individual Investors (AAII) reveals that in December 2025, the proportion of individual investors bullish on the market reached 68.7%, with only 12.3% bearish. This bullish sentiment hit its highest level since 2000, and such extreme sentiment often signals a market peak. The reason why Wall Street financial institutions are collectively issuing optimistic target prices is largely driven by their own incentive structures. Fund managers need to chase short-term performance rankings, while analysts must attract clients by proclaiming high target prices. They lack the motivation to alert investors to the market's real risks. A survey by the U.S. Financial Industry Regulatory Authority revealed that in 2025, Wall Street analysts' buy ratings for S&P 500 constituents reached 72.3%, an increase of 11.5 percentage points from 2024, while sell ratings stood at a historically low 3.8%. Yet irrational investors must transcend market sentiment, objectively interpret the warning signals from these two core valuation metrics, and approach current market conditions with caution. Faced with today's uncertain, overvalued market environment, ordinary investors are not powerless. By adopting scientifically sound strategies, they can effectively mitigate risks and seize contrarian investment opportunities concealed within 2026's market volatility. These strategies are grounded in historical experience and market principles, offering strong practical applicability. The market opportunities of 2026, however, stem from that year's unique macroeconomic environment and market dynamics. First, ordinary investors should prioritize a comprehensive health check of their investment portfolios, forming the foundation for risk mitigation. During this review, investors must abandon self-deception, objectively and honestly scrutinizing each holding. Specifically, for core issues demand attention. Firstly, valuation rationality requires meticulous analysis of key metrics such as price-to-earnings ratios, price-to-sales ratios, and price-to-book ratios. This determines whether current share prices reflect genuine corporate profitability, rather than speculative hype, particularly for AI concept stocks, distinguishing between those underpinned by core technology and earnings versus those merely riding the AI bandwagon. Secondly, the company's competitive advantage. Assess whether the company possesses unique strengths such as formidable brand influence, leading technological capabilities, a stable customer base, or significant cost advantages. Determine whether these advantages can deter competitors from entering the market and safeguard the company's long-term profitability. Thirdly, cash flow status. Free cash flow underpins a company's survival and growth. Monitor whether the company can consistently generate stable free cash flow, or if it relies on continuous financing to sustain operations. Firms perpetually burning cash without positive cash flow face substantial risks during market volatility. Fourthly, risk tolerance. One must prepare for the possibility of a substantial market correction of 30% or even 50%, assessing whether one can maintain a firm hold on one's positions. If such volatility proves intolerable, timely adjustments to holdings are necessary to reduce risk exposure. Research from the U.S. Foundation for Investor Education reveals that during the 2000 dot-com bubble and the 2008 financial crisis, investors who conducted comprehensive risk assessments and adjusted their portfolios beforehand suffered average losses 42.3% lower than those who did not make adjustments. This comprehensive health check enables investors to clearly understand their portfolio's risk profile, promptly reducing holdings in overvalued stocks lacking fundamental support, and replacing them with high-quality, undervalued assets. Secondly, maintaining a cash reserve and patiently awaiting investment opportunities constitutes the core strategy of contrarian investing. Holding a proportionate amount of cash during periods of elevated market valuations does not signify bearish sentiment, but rather ensures sufficient capital to acquire quality assets when market corrections occur. Historical experience demonstrates that genuine wealth accumulation often occurs during bear markets, when market panic prevails and the share prices of quality enterprises become significantly undervalued. This represents the optimal buying opportunity. Warren Buffett, the legendary investor, is a steadfast practitioner of this strategy. By the end of the third quarter of 2025, his Berkshire Hathaway held over $380 billion in cash and short-term U.S. Treasury bonds. This substantial cash reserve is specifically positioned to capitalize on irrational market declines, allowing the company to collect gold with a large bucket with composure. For ordinary investors, holding substantial cash reserves is unnecessary. Maintaining a cash position of 30% to 50% based on individual risk tolerance allows one to weather market volatility while remaining poised to act when opportunities arise. The Investment Management Research Association of America recommends that investors with low risk tolerance maintain a cash position of 40% to 50%, while those with moderate risk tolerance should hold 30% to 40%. And for high risk tolerance investors, the cash position should not fall below 20%. For cash management, investors may opt for low-risk, highly liquid assets such as short-term government bonds or money market funds, ensuring capital security while generating modest returns. Thirdly, focusing on a company's intrinsic value while disregarding short-term market fluctuations is pivotal to long-term investment success. Short-term share prices fluctuate frequently and unpredictably, influenced by market sentiment, capital flows, and other factors. However, long-term prices ultimately revert to a company's intrinsic value. Investors should abandon the habit of obsessively tracking daily share price movements, and instead devote greater effort to researching corporate fundamentals. This involves gaining a deep understanding of a company's business model, management team, industry standing, and growth prospects to accurately assess its intrinsic value. When the share price falls below intrinsic value, it presents a buying opportunity. Whereas when the share price significantly exceeds intrinsic value, consideration should be given to selling. As Warren Buffett observes, price is what the market pays, while value is what the business is worth. The investor's task is to buy when price falls below value and sell when price rises above value. Benjamin Graham similarly emphasized in security analysis that the essence of investing lies in identifying the difference between value and price, the margin of safety. Historical data reveals that investors focused on intrinsic value and committed to long-term investing consistently outperformed those chasing short-term fluctuations. Yale University research indicates that between 1980 and 2025, adherents to value investing strategies achieved an average annualized return of 12.3%, whereas market trend chasers averaged merely 4.7%. Fourthly, continuous learning and enhancing investment acumen form the fundamental safeguard against market volatility. Financial markets are in a state of perpetual evolution, with new investment instruments, business models, and risk factors continually emerging. Only through sustained learning and the continuous enhancement of one's understanding can investors keep pace with market developments. By studying classic investment theories, analyzing historical case studies, and monitoring macroeconomic trends and industry developments, investors can establish their own investment frameworks, cultivate independent judgment, and avoid being misled by market sentiment or rumors. Research by the American Association of Individual Investors indicates that investors dedicating at least 50 hours annually to investment education achieve long-term portfolio returns 7.8 percentage points higher than their non-studying counterparts. Investors may enhance their understanding through reading foundational investment literature, attending specialized training courses, and following authoritative financial media and research reports. Additionally, joining professional investment communities to exchange experiences and learn from peers can further refine one's investment framework. Whilst 2026 presents considerable market uncertainty, it also harbors numerous contrarian investment opportunities. From a macroeconomic perspective, the Federal Reserve will undergo leadership transition in 2026 following Chairman Powell's term conclusion. The policy orientation of the incoming chair remains uncertain. Furthermore, a significant reshuffle within the Fed's voting committee will bolster hawkish influence, intensifying policy dynamics and markedly increasing market volatility. The U.S. Federal Reserve's announcement indicates that 5 members of the voting committee will be replaced in 2026, with 4 new members holding hawkish stances. This suggests an increased likelihood of the Fed maintaining elevated interest rates or implementing further hikes. Concurrently, the U.S. midterm elections will take place in 2026. Historical data reveals that midterm election years often correspond with the poorest stock market performance. Historical U.S. stock market data reveals that between 1960 and 2022, the average annual return during midterm election years was 2.3%, significantly lower than the 8.7% seen in non-election years. Notably, stock markets declined in 62% of midterm election years. Political uncertainty will further amplify market volatility, yet such turbulence presents opportunities for contrarian investors. Market panic-driven sell-offs will offer prime moments to acquire high-quality assets. Specifically, opportunities in 2026 will primarily concentrate in 3 areas. Firstly, undervalued quality small and medium-sized enterprises (SMEs). Within the K-shaped economic divergence, many SMEs in traditional sectors despite industry slowdowns possess stable customer bases, healthy cash flows, and reasonable valuations. Due to market capitalization excessively chasing hot sectors like AI, these firm share prices are severely undervalued. As market sentiment returns to rationality, their value will be reassessed. Data from the U.S. Small Business Association indicates that by the end of 2025, 37.2% of Russell 2000 constituents will trade at price-to-earnings ratios below 15 times, with free cash flow yields exceeding 5%, representing historically low valuations. Secondly, the cost reduction segment of AI plus traditional manufacturing presents opportunities. Manufacturing enterprises applying AI technology to practical scenarios such as production line optimization, inventory management, and quality control can tangibly enhance efficiency and reduce costs. While lacking the hype of popular AI concepts, These companies demonstrate stable earnings growth and reasonable valuations, offering long-term investment value. McKinsey research indicates that manufacturers applying AI to production process optimization achieve an average 18.3% increase in productivity and 12.7% reduction in costs. Thirdly, the forced disposal of high-quality assets triggered by private credit defaults. As private credit default rates rise by 2026, creditors may compulsorily auction the equity stakes of fundamentally sound enterprises experiencing short-term liquidity constraints. Such shares often transact at exceptionally low prices, presenting bargain hunting opportunities for cash-rich investors. Moreover, investors may identify potential opportunities by observing microeconomics indicators in their immediate environment, such as the proliferation of smart community devices or the expansion of new energy vehicle charging infrastructure. These signals frequently foreshadow growth potential within related industries. Concurrently, investors should monitor global macroeconomic shifts, including the pace of Eurozone recovery and growth trajectories in emerging economies, as these factors may influence global financial market trajectories and generate fresh investment prospects. In summary, while the market in 2026 presents numerous challenges, it remains a year brimming with opportunities for prepared investors. Beneath the current market prosperity lie numerous latent risks. The interplay of factors such as K-shaped economic divergence, AI bubbles, and private credit risks could trigger fresh financial turbulence. However, by adopting scientifically grounded strategies and maintaining a rational investment mindset, investors can preserve and grow their wealth amidst market volatility. The core secret to investment success lies in remaining vigilant during market euphoria and preserving rationality during periods of market panic.